Hello, and thank you for joining me. My name is Tom Clendon, and I help students pass their ACCA SBR exams by talking about financial reporting and accounting issues. And the issue for this podcast is for us to think about the difference between a subsidiary and an associate, or if you like, the difference between a sibling and a cousin. Now, there's a misconception that the distinction is a numerical one. It's not. The distinction between a subsidiary and an associate can be grey. It can be a matter of judgment because it's a principles-based approach. It is simply the case that the definition of an associate is not a percentage. It is simply the case that the definition of a sub is not a percentage either. So let's think about what is the definition of a sub. Let's think about what is the definition of an associate. So let's first of all start with a sub. I think if you wanted to sum up the definition of a subsidiary in one word, it would be control. You know, a business combination is where an acquirer, normally the parent, obtains control of the acquiree, normally the sub, which is operating a business. Now, I want to focus on that word control today. And control is, we've got kids, and you know, when they're babies, you're in control of them. You change their nappies, you feed them. When they become teenagers, you have some sort of influence over them. And mine now, you know, my eldest two, they've grown up, they've left home, they've got married, and I have no influence over them at all. I don't have significant influence over them at all. Certainly don't have control over them. But at what point did control become influence and influence become nothing? That's what I mean. It is a grey area. But of course, IFRS 10, the accounting standard, doesn't talk about my kids. It talks about control in the way of PEA, power, exposure, ability. If you've got control over an entity, you have the P, the power to direct its financial and operating activities. You have the exposure to its variable returns, and you have the ability to exercise that power. Power to direct means that you can tell it what to do in terms of its financial and operating activities. So having control means having the power to tell them what dividend to pay, who to employ, what contracts to sign, what strategy to follow. You are in charge, the power to direct their financial and operating activities. E stands for exposure. Exposure to variable returns. Now, this means that you own shares in the company. Because if you own shares in the company and the company does well, you're exposed to variable returns. You do well as well. But if they make losses and the consequences of your decisions are negative, there's a self-harm going on. You're exposed to that risk. So exposure to variable returns means risk and rewards, I suppose. A, the ability to exercise power. So control is PEA, power, exposure, ability to exercise the power. So there isn't a legalistic, there isn't a agreement that somehow inhibits your ability to exercise control on your own. In other words, it's not a joint arrangement. You don't have to, you're not accountable to anybody else. You alone can control the entity. So the definition of a sub is based on the principle of control. Control is about PEA, power, exposure, and ability. And whilst normally, when we see a majority of the shares, that's going to indicate that we have a subsidiary, it is perfectly possible to control a subsidiary, to have a subsidiary with less than 50% of the shares and the voting rights. Perfectly possible. And if that's the case and we are in control, we still must treat it as a sub because we are interested in substance. We're interested in faithfully representing what's going on. And if we're in control, then it should be regarded as a sub. So how is it that we can control with less than 50%? There are three scenarios. You could also hold potential voting rights. So maybe you already own 30, 40% of the company, which gives you the exposure to variable returns. And in addition, you either hold options to subscribe to more shares, warrants, options, or you've got convertible bonds. So you've invested in convertible bonds, and when those bonds convert, excuse me, you would therefore have more shares, which would therefore give you a majority, which would therefore give you control at that time. So potential voting rights, you'd need to examine whether they were substantive. So the options would presumably have to be exercisable now. The convertible bonds would have to be exercised, because if they're not exercisable for 10 years, forget it. You haven't got control. Just because in theory in 10 years time you would have a majority, the company would manage without you and without your input. So three scenarios where you could have control with less than 50%. Potential voting rights is one. Secondly, consider the size and the disposition of the other shareholdings. So you could own 40%, and if the other 60% of the shares are owned by unconnected individuals, unconnected investors who all own a very small amount, then maybe, just maybe, in reality, at a shareholders meeting, you've always got a majority because some of them don't turn up, some of them will agree with you, and only a few will disagree with you. So look at the economic reality, look at the faithful representation, look at the size and the disposition of the other shareholdings. I mean, if there's only one, if you own 40% and the other shareholding is 60%, you haven't got a sub. I mean, you're a non-controlling interest in somebody else's sub. Yeah, you probably even haven't got influence. You've probably just got an investment. So it's always about understanding how you stand in relation to everybody else. And thirdly, it is possible for you to achieve control of a subsidiary with less than 50% if you've got an agreement with other shareholders. So again, I could own 40% of the shares, and I could have a sister who owns 20%, but my sister may be ill, or my sister, may be in prison or something, and doesn't want to get involved in the running of the company. So I could have a power of attorney over her votes. She would still own the shares. I don't have to consult her. I don't have to make any form of communication with her. I would have an agreement with her where I exercise her vote as I see fit. So I would therefore own 40% of the shares, which will give me the exposure to variable returns, but I would have the power to direct the company because I would always be able to appoint the directors. I would have a 60% control over the voting rights. So I would then have to consolidate the business as a sub, but because I only own 40%, there would be a 60% NCI, but it would still be a sub. Okay, we know what a sub is, something that we control, which is normally the case when you've got a majority, but can also be the case if you've got less than 50%. Let's think about an associate. Now, an associate is defined with the key term significant influence. It's an investment over which you can exercise significant influence over their financial and operating activities. So again, it's about the decision-making process of the entity. You see, if you're in control and you ask to jump, you say jump, the answer you should get back is how high? That means you're in control. But if you've only got significant influence, sometimes they will jump and sometimes they won't. Significant influence means that you have the ability to reason and participate in the decision-making process before the decisions are made. You don't always get your own way, but you're not always ignored. And so for me, the classic way of evidencing significant influence over the financial and operating activities of an entity is to be on the inside, is to have board representation. One director out of 3, 2 directors out of 5 is indicative that when a decision is being made, your voice can be heard, but you're not always going to get your own way. Other indicators of significant influence include trading links, buying and selling goods with each other, exchanging of staff, technical training, that kind of thing. And the lazy way or the presumption is that you've got between 20 and 50%. If you own between 20 and 50%, the assumption is that you've got significant influence, and therefore the assumption is it's an associate. But it's not a golden rule. You can own 30% and have no influence if it's someone else's sub, for example. You can own 40% and actually have control. So it's all about the reality. You know, you can have 18% and have influence because you've got board representation. So the number is a guide and not a rule. The definition of an associate is a principle based on significant influence. Now, why does all this matter? It matters because the accounting is fundamentally and totally different, whether you're dealing with an associate or whether you're dealing with a sub. If it's a sub, it's acquisition accounting. If it's a sub, you fully consolidate the assets, the liabilities, the income, the expenses on a line-by-line basis. You calculate goodwill, you show the NCI. If it's an associate, significant influence, if it's an associate, then it's equity accounting. It's one line in the income statement, one line in the profit and loss account, one line on the balance sheet, one line on the statement of financial position, just one line. Now, what that means is that if you're looking at an investment, if you're looking at an entity that you've invested in, that you own shares in, and that entity is highly geared and loss-making, there will be a creative accountant who would argue, oh, it's an associate. Oh, we don't really control this mess. Because if you admit to control, then you have stewardship. If you admit to control, you've got to aggregate the assets and the liabilities in full. So the liabilities are in full appearing in your accounts. Your gearing goes up. Whereas if we say, oh, actually, we only participate in the decision-making process, we're not really in control, it's an associate, and you just have the investment as one line, and those liabilities are not consolidated. So there is a cynical, creative accounting angle potentially to this distinction. So let me recap. If it's a sub, it's because you've addressed the principle of you being in control. PEA, P, power, exposure, ability. Acquisition accounting, line by line, cross-casting. If it's an associate, it's because in principle, you recognize that you've got significant influence, probably board representation, probably between 20 and 50%, and the accounting treatment is equity accounting, which is a single line. Wow. I hope that is clear. I hope you've enjoyed listening to this. There are plenty of other podcasts around for you to listen to in this series. I also write articles that I publish on LinkedIn. So if you haven't found me on LinkedIn, find me there And also you can catch up with various bibs and bobs going on my website, which is www.tomclendon.co.uk. If I can help you pass your SPR exam, please reach out to me and I will be happy to do so. Thank you very much for listening.